Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, markets are off to a rough start this year.
Yeah.
The NASDAQ is down over 10% this year, and we're only a month, not even a month into the year. And the S&P 500 is approaching correction territory. So let's talk about some of the current factors driving the pullback in the equity markets.
Yeah, not to sound like a broken record, Steve, but a lot of the current market anxiety is being driven by the Fed, or how the investors feel the Fed is going to act this year. Year-over-year inflation number for December came in at 7%, and that's the highest we've seen since 1982. Attempting to curb inflation, the Fed plans to hike interest rates this year multiple times. Some people think it's going to be 3 times. Some people are predicting 4 times. Regardless, a higher interest rate or higher discount rate, when we plug that into our discounted cash flow model, equals lower current value. So you're seeing the market react to that. And higher interest rates particularly hurt growth stocks more because most of their value is on earnings that are far into the future. You discount that back now. And that's why you see the NASDAQ off more than the S&P 500, at least to this point in the year.
Yeah, and Travis, it's times like these where we need to remind ourselves that market volatility is normal. Data from JP Morgan shows that since 1980, the average intraday year decline in the S&P 500 is right at around 14%. So any given year, we can expect a market drawdown of about 14%, and that number grows in midterm election years to 17%. So it gets a little bit bigger.
Well, add politics to any situation, Steve, and I expect the volatility to go up. But in those 42 years since 1980, Steve, 32 of those years, we've had a 14% drawdown, like you said, but in 32 of those years, the market has ended positive. So those drawdowns we're talking about tend to be temporary.
Yeah. No, that's a good point, Travis. So if you find yourself being anxious and checking your accounts on a daily basis during this period of volatility, your risk tolerance may not be as high as you thought it was.
No, that's a good point. And the reality is people dislike losses almost twice as much as they like gains. And that feeling, I think, might be amplified because we're coming out of a period of reduced volatility, so people aren't used to this. I always like to tell people, and I mean, this is sound advice, it's best to have a plan in place going into the volatility or before volatility strikes. You want to put yourself in a position to weather market storms, and that means you don't overextend risk, you don't over leverage, and in the short term, that may feel like you're giving up some opportunity to the upside, but you won't be a forced seller during times of market stress, and better yet, if you're positioned right, you can actually be a buyer from those forced sellers at favorable prices.
Absolutely correct, Travis. It couldn't have been stated more appropriately in this time frame. This has been great. I look forward to it next week.
I look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.